Smart, educated, hardworking, yet somehow still not wealthy. Look around and you'll see it everywhere. People with advanced degrees, impressive careers, and strong incomes, still living paycheck to paycheck. Still stressed about money, still feeling like financial freedom is always 5 years away. So here's the uncomfortable question. If intelligence and education are supposed to lead to success, why do so many smart people struggle to build real wealth? Is it a lack of opportunity, bad luck, or something far more subtle? The way they think about money. Because here's the truth, most schools never teach. Being smart is not the same as being financially intelligent. In fact, in many cases, intelligence can quietly work against you, creating habits, fears, and blind spots that sabotage wealth over decades. In this video, we're counting down 10 reasons smart people still don't build wealth. Not to criticize, but to reveal the hidden patterns that keep capable people stuck. And we're starting with a mistake so common, so invisible, that most people never realize it's costing them years of progress. The belief that thinking harder leads to better financial results. Let's begin. Here's a hard truth most people never want to hear. Being smart does not guarantee financial success. In fact, intelligence can sometimes become a disadvantage. Think about it. Smart people are trained to analyze, compare, optimize, and avoid mistakes. Those are valuable skills in school and in careers. But money doesn't always reward the best thinking. It rewards the right behavior, repeated consistently over time. Many highly intelligent people assume their brain will eventually solve their money problems. If they just read one more book, run one more spreadsheet, wait for one more confirmation, things will click. But wealth doesn't come from knowing more. It comes from doing a few simple things well for a very long time. Warren Buffett has said that investing is about having a high IQ. It's about temperament, patience, discipline, emotional control, the ability to stay calm when others panic and to act when others freeze. And that's where intelligence can quietly backfire. Smart people often overestimate their ability to figure it out later. They delay decisions, they second-guess simple strategies, they believe complexity equals superiority. Meanwhile, average investors who follow boring, repeatable habits keep moving forward. Here's the irony. The market doesn't reward brilliance, it rewards consistency. You don't get paid for being right in theory. You get paid for staying invested, managing risk, and letting time do the heavy lifting. So if you've ever wondered why someone less educated seems to build wealth faster than someone smarter, this is often why. And it leads directly to the next mistake smart people make with money. They think more information leads to better outcomes, when in reality, it often leads to doing nothing at all. Smart people love information. Data feels safe, research feels productive, thinking feels responsible. But when it comes to money, overthinking can quietly destroy opportunity. Analysis paralysis happens when the need to be right becomes stronger than the willingness to act. You want the perfect plan, the best timing, the optimal strategy. So you wait. And while you wait, time keeps moving. Markets compound, businesses grow, assets appreciate, but only for people who are actually in the game. Highly intelligent people often convince themselves they're being cautious. In reality, they're postponing discomfort. Every investment decision carries uncertainty, and smart people are trained to minimize uncertainty at all costs. So they ask endless questions. What if the market crashes? What if there's a better option? What if I start at the wrong time? The result is months, sometimes years, of preparation with no progress. Meanwhile, someone else with less knowledge but more decisiveness starts early. They make small mistakes, they learn by doing, and most importantly, they give compounding something to work with, time. Charlie Munger once said the big money isn't in the buying or selling, it's in the waiting. But you can't wait if you never begin. Overthinking feels intelligent, inaction feels invisible. But together, they quietly sabotage wealth. The uncomfortable truth is this. A decent plan today usually beats a perfect plan that never starts. And that leads to the next trap smart people fall into. The belief that unless everything is perfect, it's better not to move at all. Perfectionism often looks like discipline, but financially, it's usually fear in disguise. Smart people are trained to get things right. In school, mistakes are punished. Wrong answers cost grades. So over time, perfection becomes the goal, not progress. That mindset carries over into money. They don't want to invest until they understand everything. They don't want to start until conditions are ideal. They don't want to commit unless success feels guaranteed. But wealth doesn't work that way. There is no perfect time to invest, no perfect strategy, no moment where risk disappears. Historically, the biggest cost to investors isn't market crashes, it's sitting on the sidelines. Missing just a handful of the market's best days can drastically reduce long-term returns, and perfectionists miss those days because they're always waiting for clarity that never fully arrives. Warren Buffett didn't wait for perfect information. He waited for reasonable certainty, and then acted. He accepted that some decisions would be wrong because the cost of inaction was worse. Perfectionism feels responsible, but it quietly steals the most valuable asset in investing: time. Every year you delay, compounding has less room to work. Every month you wait, inflation quietly erodes your cash. Every almost ready moment pushes progress further away. Wealth favors people who start early, adjust often, and stay consistent, not those who wait until everything looks flawless. And here's the shift most people miss. Success doesn't come from thinking better plans, it comes from following through on simple ones. That's where we're going next. Because follow-through, not intelligence, is the real skill behind long-term wealth. One of the most dangerous financial illusions is a high income. Smart, educated people are especially vulnerable to this trap because society constantly rewards them for earning more. Promotions, raises, bigger titles, bigger paychecks. It feels like progress. But income is not wealth. Income is what comes in. Wealth is what stays and grows. You can earn 6 figures and still be financially fragile. One missed paycheck, one medical bill, one job loss, and everything starts to crack. Meanwhile, someone earning far less, but consistently saving and investing, quietly builds real security. Here's the problem. As income rises, spending usually follows. A nicer apartment becomes a need. A better car feels justified. Upgrades slowly turn into obligations. This is lifestyle inflation, and it's one of the main reasons high earners stay broke. Morgan Housel often reminds us that wealth is what you don't see. It's not the car in the driveway or the watch on the wrist, it's the money you didn't spend, the capital quietly compounding in the background. Smart people are taught to optimize earnings, not restraint. They focus on negotiating salary, switching jobs, climbing ladders, all useful skills. But without controlling spending, higher income just creates a more expensive life. Net worth grows in the gap between what you earn and what you keep. Not by impressing others, not by consuming more, but by consistently saving and investing the difference. And this leads to a subtle but powerful realization. Building wealth isn't about making more money, it's about managing behavior. Which brings us to the next reason smart people struggle financially. Because money decisions are rarely logical, they're emotional, and behavior quietly overrides intelligence every time. Most people think money problems are math problems. They're not. They're behavior problems. You can understand compound interest, diversification, and budgeting, and still make terrible financial decisions. Because when real money is involved, emotions take over long before logic gets a chance to speak. Fear, greed, ego, short-term comfort. These forces don't care how smart you are. Highly intelligent people often assume they'll act rationally when the time comes. But history shows the opposite. During market booms, people chase what's already expensive. During downturns, they panic and sell. The decisions feel logical in the moment, but they're driven by emotion, not strategy. Warren Buffett has said the most important quality for an investor isn't intelligence, it's temperament, the ability to stay calm, patient, and disciplined when others lose control. Behavior shows up in small, repeated habits. Spending to relieve stress, avoiding account balances when things feel uncomfortable, delaying decisions to avoid anxiety. Over time, these habits compound, just like money does. 2 people with the same income and the same knowledge can end up in completely different financial positions. The difference isn't what they know, it's what they consistently do. Smart people often underestimate this. They believe insight leads to action. In reality, action comes from emotional regulation and clear rules, systems that work even when motivation disappears. Once you understand this, everything changes, because the real battle isn't learning more, it's managing how you behave under uncertainty. And that brings us to the next issue, a deep, often unspoken one. The way smart people think about money often creates fear, even when the math is on their side. Fear is one of the most powerful forces in finance, and shame quietly makes it worse. Smart people don't like being wrong. They especially don't like feeling behind. So when money becomes stressful, many choose avoidance over action. They delay looking at statements, they postpone decisions, they tell themselves they'll deal with it later, but later rarely helps. Fear shows up as overcaution. I'll invest when things feel safer. I'll start once I know more. I don't want to lose what I've worked so hard for. Shame shows up as silence. People don't talk about money struggles. They don't ask questions. They don't seek help because they think they should already know better. This emotional combination is toxic. Instead of making small, manageable moves, smart people freeze. Or worse, they make rushed decisions just to escape discomfort, selling at the wrong time, avoiding opportunities, or trusting the wrong advice because it promises certainty. Howard Marks often says that risk isn't volatility, it's the permanent loss of capital. But fear convinces people that any short-term decline is danger, even when long-term odds are favorable. The most successful investors don't eliminate emotion. That's impossible. They manage it. They expect uncertainty. They plan for discomfort. They build rules that protect them from themselves. Automatic investing, clear asset allocation, long-term time horizons. These systems reduce emotional interference, because wealth isn't built by avoiding fear. It's built by acting despite it, calmly, deliberately, and repeatedly. And once fear is controlled, a new question emerges. If emotion is the enemy, why do smart people still complicate money? That takes us to the next reason, the false belief that complexity equals intelligence, and that simple strategies can't possibly work. Smart people are often drawn to complexity. Complex feels advanced. Complex feels sophisticated. Complex feels like an edge. But in finance, complexity is usually a distraction. The most reliable wealth-building strategies are almost boring in how simple they are. Spend less than you earn, invest the difference, diversify, keep costs low, stay invested for a long time. That's it. And yet, many highly educated people ignore these fundamentals. They chase advanced strategies, timing models, stock-picking systems, and clever shortcuts. Not because they work better, but because they feel smarter. Warren Buffett has said that investing is simple, but not easy. The math is basic. The behavior is hard. Historically, broad market index funds have outperformed the majority of professional investors over long periods. Not because they're brilliant, but because they avoid mistakes, fees, and emotional trading. Fancy strategies often fail for one reason. They require perfect execution. One wrong assumption, one emotional decision, one bad year, and the whole plan unravels. Simple strategies are more resilient. They don't rely on predictions. They rely on probabilities. They assume you'll be imperfect, and they still work. Ray Dalio often emphasizes that you don't need to be right all the time. You just need a system that survives being wrong. Basic financial building blocks do exactly that. They protect you from your own impulses. They let time and compounding do the heavy lifting. Here's the uncomfortable truth. Simple math, applied consistently, beats smart guesses almost every time. And once you accept that, another problem becomes obvious. If the fundamentals are so effective, why don't more smart people follow them? That leads to the next reason, the gap between confidence and action that quietly holds intelligent people back. Here's a strange paradox. Many high earners are confident in their careers, yet honestly, they can feel insecure about investing. They run teams. They make big decisions at work. They solve complex problems every day. But when it comes to money, they hesitate. Why is that? Well, competence in one area doesn't automatically transfer to another, and smart people are, painfully aware of what they don't know. That awareness creates doubt. I'm not an expert. I don't want to mess this up. I should understand more before I start. So they avoid investing altogether, or sometimes they outsource decisions without really understanding them. Ironically, people with less education often start sooner. They may not know all the terms, but they trust simple rules and just learn along the way. Over time, experience builds real competence. Smart people often do the opposite. They wait to feel confident first. But here's the thing. Confidence doesn't come before action. It comes from action. Most successful investors didn't start confident. They started curious. They made small bets. They made mistakes. And slowly, competence replaced fear. There's also an ego trap here. Admitting beginner status feels uncomfortable for someone used to being competent. So instead of starting small, they delay entirely. This creates a costly gap. Years pass with money just sitting idle. Inflation quietly erodes purchasing power. Compounding never even gets a chance to begin. The market doesn't care how capable you are at your job. It only rewards participation over time. And this brings us to the silent force that separates those who build wealth from those who don't, even among equally smart people. It's not intelligence, it's not confidence, it's whether you actually take action and keep taking it long enough for time to work its magic. At some point, learning becomes a hiding place. Smart people consume books, podcasts, articles, and videos about money. They know the theories. They understand the terminology. On the surface, they look financially literate. But knowledge without action is just potential, and potential doesn't compound. The biggest difference between people who build wealth and those who don't isn't what they know, it's whether they turn understanding into behavior. Buying your first index fund teaches more than 10 books about investing. Tracking spending for 1 month teaches more than years of budgeting advice. Staying invested through a downturn teaches more than any classroom ever could. Action creates feedback. Feedback builds confidence. Confidence reinforces action. This loop is how real financial skill is formed. Smart people often reverse the order. They wait to feel ready before acting. But readiness is an illusion. You don't feel prepared until you've already started. Naval Ravikant once said that clear thinkers win in the long run, but only if they move. Insight without execution doesn't change outcomes. Wealth is built through small, imperfect actions repeated consistently. Automatic contributions, regular investing, simple rules followed even when motivation fades. This is why people who start early, even with less knowledge, often end up far ahead. They gave time something to work with. And once you accept this, everything points to one final truth. There's a deeper reason smart people struggle financially. It's not intelligence. It's not access to information. It's the way they were taught to think and what they were never taught to question. That brings us to the final and most important reason of all. Every reason we've covered leads back to this one truth. Wealth is not built by intelligence alone. It's built by mindset. Most smart people were taught what to think, not how to think about money. School rewards correct answers. Careers reward performance and credentials. But wealth rewards long-term thinking, delayed gratification, and independent judgment. If you believe money comes primarily from income, you'll chase raises. If you believe wealth comes from timing, you'll wait. If you believe mistakes are dangerous, you'll avoid action. But once your mindset shifts, behavior follows. Wealthy individuals tend to see money as a tool, not a scorecard. They focus less on looking successful and more on building freedom. They accept uncertainty as the cost of growth. They understand that being wrong occasionally is part of the process, not a failure. This shift is subtle but powerful. Instead of asking, "What's the smartest move?" they ask, "What's the most repeatable habit?" Instead of trying to predict the future, they design systems that work across many possible futures. Instead of reacting emotionally, they rely on rules. Invest regularly, keep costs low, stay patient. Here's the simple habit you can start today. Decide in advance how you'll handle money before emotion shows up. Automate saving, automate investing, remove decisions from moments of stress. When behavior is automated, intelligence stops getting in the way. The real financial gap isn't between smart and not smart. It's between those who design their behavior and those who rely on willpower. And the moment you shift your mindset from trying to be clever to trying to be consistent, wealth stops being complicated. It becomes inevitable. So remember this, your degree may open doors, but only your daily decisions build wealth. Think long-term, act consistently, and let time do what intelligence alone never can.